I think we all face the job of getting the economy on a sustainable, non-inflationary path. And in the most general terms, it's the job of the Federal Reserve and the job of all of us to take the actions that are necessary to achieve that.
Test for us, the challenge for us is to start fast. Just stick to the script, man.
USA Tonight with Brad Holbrook.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points. The day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver.
Shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%. NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
These sectors, Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
The virus has spread and impact to very high, the same level as it's had for China since late January.
Take a look at the S&P 500 over the last 3 years to put this drop in some kind of context. We've been talking about this is the fastest 12% loss in history, measured.
Laboratories as a part of the U.S. response to be able to monitor this new epidemic that's really becoming a pandemic pretty quickly.
Cessation in ticks on the S&P.
Yeah.
Means the first circuit breaker
whom the bell tolls
has been triggered.
Federal Reserve cutting interest rates by 50 basis points, making a surprise announcement of a 50 basis point rate cut. The Federal Reserve saying the coronavirus poses an evolving risk to economic activity, though the fundamentals of the U.S. economy remain strong. The statement.
The equities down and down hard. Thursday was the biggest drop since '87. Friday, the biggest pop since '08. And guess what? We're back down with futures limit down going into the cash open.
The U.S. economy prospered on balance during the Fed's first 15 years, but in 1929, the world entered a global depression. So what happened there was A global depression happened because there was a connection between gold and monetary policy, and there was not enough gold to be distributed evenly amongst the world. So we had high inflation and we had commodity prices rising. So imagine gold being the gold standard in value for monetary policy and money, but there's not enough to evenly go around the world. We're going to focus a lot of this video on modern day times. And what I mean by modern day times, 1990s all the way to the current year, 2022. And the reason being, you can't apply what happened in 1930s and above to current times, because much of the Fed's policies that we're currently using today, such as quantitative easing or QE or quantitative tightening, QT, didn't apply back then. So why would we apply past times to current times? So we're gonna try to focus and narrow in on current times. There will be shades of the past in this video, but most of the focus will be on modern day policies, such as quantitative easing and quantitative tightening. That's QE and QT. Let's begin with media manipulation. And the reason I say media manipulation is because Wall Street controls the media. For example, there's a guy, Jim Cramer, on Wall Street. You might be familiar with him. He used to work for the institutions and the banks. I'll give you an example. Bear Stearns went out of business back in the days, and Jim Cramer went on record and said, you don't have to worry about your money with Bear Stearns. So a lot of people took his word, kept their money in Bear Stearns, didn't sell, and as a result lost millions, if not billions, in totals. So you can't always believe what the experts say or the media, because most of them are paid. Jim Cramer included. He is paid. So take this example as a lesson why you can't trust the smart money, as they call it.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than the plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly.
Watch how Jim Cramer reverses and pivots on what he said before.
He has no idea how bad it is out there. He has no idea. He has no idea.
Cramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
But Cramer, if he did what you said, which seems to me from the way you just explained yourself,
cut the rate. Open the discount window.
Okay,
cut the
but
rate.
if he comes
Relieve
out
the
next
pressure.
week and cuts rates,
Relieve the pressure.
You're going to have, that's going to cause Armageddon.
No, we have Armageddon. I wouldn't try to cause it. We have Armageddon. In the fixed income markets, we have Armageddon.
It's repricing. They're very firm about that even
great.
now.
Okay, well, let them be calm and then have them call me on the way home like they do every night and tell me, Cramer, what are you going to do about it? Are you going to help us? Are you going to help us? Are you going to stand on the sideline like everybody else and say that it's fine? Will somebody come on TV and tell the truth?
So you can't trust the smart money. So if you're watching news, be careful how the media manipulates your actions to buy or sell. Always, always, always question. Never stick to the script.
I am sorry to be upset about it, but you have to understand what they're saying to me off the record before I come in here every night and every day.
Wait, did Jim Cramer just admit that Wall Street calls him off the record? Yeah, that's shady. Why is Wall Street calling you off the record? That means that you're a paid media employee by Wall Street, and your job is to create fear or euphoria. So, watch out for Jim Cramer and the stock gurus. You never know who's being paid to manipulate your thoughts. Let's take a look at this chart. Bear Stearns. This was Bear Stearns at an all-time high of 160 before it all came to a halt. Bear Stearns no longer is in business. It's one of the companies that collapsed, and a big major reason why we have monetary policy today. So Bear Stearns had a $1.6 billion loss. Later on, Q3 of 2008, $859 million loss, until eventually they just plunged and collapsed, and eventually was bought for $236 million by JP Morgan Chase. So that goes to show you why you can't follow the media and listen to them manipulate your thoughts. You always have to be mindful and think for yourself. You can never take the experts or the smart money's advice without evaluating your own thoughts. What you see a lot of times on Wall Street, you'll see executives leave and go to other companies. So much of the smart money that you considered smart with Bear Stearns and had major losses, they're now working for other hedge funds right now in America. So all you're seeing is executives recycled, and they pop up at different banks, different institutions. So the smart money or dumb money in this situation is still there.
Yes! It worked, you guys! It actually worked! What worked? Everybody bought the whole act. They keep giving and giving until we have it all. What? You're keeping that money yourself? Of course, you guys! And then we can make $10 million!
The fear gauge. We've talked about the fear gauge in previous videos before. What the fear gauge is how Wall Street prices in the public's sentiment. So fear has an effect on the price of stock. And the reason being is that if nobody is buying, they have to entice the prices by making them cheaper. And so that has an effect on you as a consumer and as an investor. So if there's low prices because fear, there's going to be high prices when there's not fear. So I'll give you an example. VIX. This is a volatility index. So one way to describe it is a fear gauge. And in 2020, right there where you see it spike up, that's because of the pandemic and COVID. So it created a lot of fear. It went up to a high of 67 during the peak of the pandemic because of COVID-19, and you've seen lockdowns and shutdowns. So the fear gauge is a handy tool for you to use. It's called the VIX, the volatility index, or as some refer to it, the fear gauge. You have to have public confidence in the institutions. Without public confidence, that's what led to bank runs in the 1930s. And what bank runs is, that's when everyone took their money out at the same time. And if that happens, that could be catastrophic to financial institutions and America. Because you see, money makes the world go round. And without public confidence, it's disastrous to an economy. So public confidence is everything. America's lost confidence in banking institutions before. And without public confidence in the banking institutions, you don't have an institution or system. So in 1933, 1934, Congress passed the Glass-Steagall Act. And this was based on two men, Carter Glass and Henry Steagall. Both of them created the Glass-Steagall Act. And what this act meant was that the banks would be covered in an event that they can't pay. So that's why you see FDIC in short, and that was a system to protect the public's confidence and restore it, because the Great Depression caused many people to hold on to their money. Nobody wanted to bank in the systems, and there was thousands of bank failures in the first years of the Depression. So this provision prohibited banks from investing in risky securities. So yeah, that's that. Some of the most powerful people in America work on Wall Street, such as Jamie Dimon. And the reason being is that money drives the world. So a lot of these Wall Street executives, they go on to work in Washington, D.C. as policymakers, and they assist one another. Or just like Alan Greenspan, they work for the Federal Reserve, and they have a lot of influence on the world, such as 2008 when the financial market collapsed. When the world loses confidence in public systems, such as the central banking system, it creates catastrophic events where there's no looking back. And all it takes is one pillar of the stone for it all to come tumbling down.
Everyone is talking about inflation. Inflation.
Inflation. Everyone's talking about inflation right now. And the reason being, the cost of goods and services today cost more than they did yesterday. That's pretty much inflation in a nutshell. But let's break it down even further. So let's take a look at this chart. This is a CPI chart. Consumer Price Index is showing inflation's ups and downs over the years. Let's lock in right here at 5%. So what you see is in the last 13 years, you've seen a rise in inflation. They like to keep it at 2.5%. That is a neutral rate that's considered stable by central banks and the Federal Reserve. So 2.5% is a neutral rate. So we're going to take a closer look at the chart. If you look at 1940, you had the peaks and you had the valley. So you see this up and down roller coaster approach. And then things settled down between the 1950s and the 1970s. And then we've seen inflation rise again from 1970 with a peak at 80, and then it went down. Now it's currently on the rise. Which, if you recall, in modern day times, inflation is on the rise, and Jerome Powell called it transitory, meaning temporary. Listen in on it.
This is an extraordinarily unusual time.
Several points in times of America's existence, we've dealt with high inflation. I'm not old enough to remember, but I've heard stories about the 1970s and how inflation impacted my parents. So what you have here is a chart showing from 1965 to a peak of 1982, inflation on the rise, peaking at 15%. Each gray bar represents a recession. So you see 1960, 1970, 1980, and the thicker the gray area, the longer the recession. So the recession that's circled currently at the time, 1980, that was a short-lived recession. And that was because Paul Volker, the Fed Chairman at the time, had to kill the economy. And how he killed the economy was by raising rates up and stifling the demand for goods and services, which created other issues such as a high unemployment rate. So if you look right there, you see in the 1980s, high unemployment. The unemployment rate shot up because anytime you raise the Fed rate, that's the borrowing rate on which people borrow money, there's going to be some impact in the unemployment rate. So Paul Volker killed the economy by raising the federal interest rate. In the 1970s, you had people picketing because the price of food had increased by so much. You've seen unions and laborers protesting because unemployment rates.
Here in New Jersey, 10% of the workforce is unemployed. Across the nation, the average is 8%.
Inflation was creeping during the 60s under Lyndon B. Johnson at the time due to conflict in the Vietnam War, but the double-digit inflation didn't start until Richard Nixon, the president at the time.
The time has come for a new economic policy for the United States.
In 1971, Nixon disassociated the backing of money with gold.
Inflation robs every American, every one of you.
We must whip inflation right now.
These policy missteps happened under Ford and Carter and led to the OPEC and the gas prices rising because of the oil embargo.
Domestic problem. That problem is inflation.
It wouldn't be until Jimmy Carter appointed Paul Volker, who was the Fed chairman at the time, that inflation started to decline. So the Federal Reserve created actions such as raising rates in order to kill inflation. You've seen the price of food, the price of gas, and everything else going up at the time. So the only way to control inflation was to kill the economy.
I graduated from college in 1975. I had a front row seat. Nothing like that. I don't expect anything like that to happen.
Let's take a look at the chart again of inflation. As you can see, during the 60s, it was below the neutral rate, which is 2.5%. And then you see a steady incline, a rise in inflation, going from just below 2.5 all the way to 5.5%, maybe 6%, and then a recession. So anytime you see inflation, there's a legit concern for a recession. And that's what you see the gray bar on the right side of the graph showing 6% inflation. You see during the 1970s a recession. And it was many things that led to the recession of the 70s, such as high gas prices plus the oil embargo. And that was because of the actions of the USA getting involved in a conflict between Middle Eastern countries, and the Middle Eastern companies led by OPEC decided to freeze America out, which in turn raised gas prices. Which, let's zoom out for a minute. We're gonna zoom out right now and take a look at this chart. 2020, during the pandemic, you've seen inflation steady rising, but they got a hold of it by monetary policy and quantitative easing. You see in the 1980s, you see 12.5%. That was the peak. And then for years, after 1970, which was over 40 years, you've seen low inflation. And you didn't see a rise in inflation until 2022. And the reason being is that we pumped so much money into the economy with monetary policy such as quantitative easing, QE, that it created a large amount of spending and an increase in goods and services. So you have multiple things going on. You have the war in Ukraine and Russia, and you have monetary policy such as QE. You have government buying of bonds. You have stimulus packages, which most people spent a lot of money. So you see an increase in demand, but you see the cost in the goods and services increasing. So we need to get a hold of it.
Inflation in particular categories of goods and services that are being directly affected by this unique historical event that none of us has lived through before, called reopening.
Many of the actions of the Federal Reserve, such as quantitative easing and continuing it when they should have stifled it, along with the stimulus package, gas prices, war in Ukraine, has led to the stock market having volatility, such as the S&P 500, which on September 13th dropped more than 4%. That was a huge negative red day. Let's listen in on this.
The Fed is much maligned and little understood. Perhaps you could fill us in on what is the mission of the central bank in the United States?
Well, the mission of the central bank originally was to do bailouts when there was a panic. There was a huge panic on Wall Street in 1907, And the private financier, JP Morgan, was the person who corralled all the big bankers in New York in his library and wouldn't let them out until they agreed collectively to stabilize the financial system. And after that experience in 1907, people figured, well, we can't just leave it to chance. We can't just leave it to there being a titan like JP Morgan. We ought to have a public institution, a central bank, that can stand behind the private banks and be ready with liquidity if there's a run on the banking system. So that was the original purpose of the Fed. And then it's evolved so that inflation stabilization and broader financial stabilization has become part of the mission as well.
Now, how does the Fed go about curbing inflation, stabilizing inflation, as you put it?
Well, basically, if the inflation is going up, it's normally because too much money is chasing too few goods, too much demand. So you have to reduce the spending, reduce, that is, the demand, by making it more expensive to borrow. And if it's more expensive to borrow because interest rates are higher, then households will borrow less to spend, companies will borrow less to invest, and you'll cool down the whole system. So you have to reduce the spending, reduce, that is, the demand, by making it more expensive to borrow. And if it's more expensive to borrow because interest rates are higher, then households will borrow less to spend, companies will borrow less to invest, and you'll cool down the whole system and get rid of the inflation.
And the Fed does this by setting the short-term interest rate.
That's right. They raise the short-term interest rate, and then that ripples through the other interest rates, the 2-year, the 5-year, the 10-year, and makes borrowing more expensive.
Now, do they just periodically raise or lower the interest rate, or do they telegraph their punch and say, in the coming year, we're going to raise it 25 basis points?
That's a fascinating question because the practice has evolved over time. It used to be that central bankers made a virtue of surprise and secrecy, and they wouldn't even tell you after they decided to raise the interest rates. They would just instruct the dealers in the New York Fed to buy or sell securities to move the interest rate around without even announcing it. But increasingly, the Fed has decided that it's good to telegraph this stuff in advance. So now, at the time of every meeting, the Fed puts out the forecast of each of its policymakers, and this is called the dots plot, where they say in advance how many rate increases they're expecting in the next 12 months.
Fed chairman in America, their main job is to control the economy. And by controlling the economy with monetary policy and easing concerns of the public and consumer sentiment. The role of a federal chairman is to control prices and restore consumer confidence and keep it at ease. Every last federal chairman, going back to Paul Volker, Alan Greenspan, Bernanke, Janet Yellen, to Jerome Powell, the current federal chair. Their job is to restore consumer confidence and keep inflation low. So the Fed is willing to do anything and everything to stabilize the markets, including killing the economy.
Dr. Greenspan, I want to start with you. You were the longest-serving chairman of the Federal Reserve in history, and during this period of time, you were perhaps the leading proponent of deregulation of our financial markets. Certainly, you were the most influential voice for deregulation. You have been a staunch advocate for letting markets regulate themselves. Let me give you a few of your past statements. In 1994, you testified at a congressional hearing on regulation of financial derivatives. You said there is nothing involved in federal regulation which makes it superior to market regulation. In 1997, you said there appears to be no need for government regulation of off-exchange derivative transactions. In 2002, when the collapse of Enron led to renewed congressional efforts to regulate derivatives, You wrote the Senate, "We do not believe a public policy case exists to justify this government intervention." And earlier this year, you wrote in the Financial Times, "Bank loan officers, in my experience, know far more about the risks and workings of their counterparties than do bank regulators." And my question for you is simple. Were you wrong?
Partially, but let's separate this problem into its component parts. I took a very strong position on the issue of derivatives and the efficacy of what they were doing for the economy as a whole, which in effect is essentially to transfer risk from those who have great difficulty in absorbing it to those who have the capital to absorb losses if and when they occur. These derivatives are working well. Let me put it to you very specifically.
So you don't think you were wrong in not wanting to regulate the derivatives?
Well, it depends which derivatives we're talking about.
Okay.
Credit default swaps, I think, have serious problems associated with them. But the bulk of derivatives, and indeed the only derivatives that existed when the major discussions started in 1999, were those of for interest rate risk and foreign exchange risk.
Let me interrupt you because we do have a limited amount of time, but you said in your statement that you delivered, "The whole intellectual edifice of modern risk management collapsed." You also said, "Those of us who have looked to the self-interest of lending institutions to protect shareholders' equity, myself especially, are in a state of shocked disbelief," end quote. Now that sounds to me like you're saying that those who trusted the market to regulate itself, yourself included, made a serious mistake.
Well, I think that's true of some products, but not all. I think that's the reason why it's important to distinguish the size of this problem and its nature. And what I wanted to point out was that the excluding credit default swaps, derivatives markets are working well.
Well, where do you think you made a mistake then?
I made a mistake in presuming that the self-interest of organizations, specifically banks and others, was such as that they were best capable of protecting their own shareholders and the equity in the firms. And it's been my experience, having worked both as a regulator for 18 years and similar quantities in the private sector, especially 10 years at a major international bank, that the loan officers of those institutions knew far more about the risks involved in the people to whom they lent money than I saw even our best regulators at the Fed capable of doing. So the problem here is something which looked to be a very solid edifice and indeed a critical pillar to market competition and free markets did break down, and I think that, as I said, shocked me. I still do not fully understand why it happened, and obviously to the extent that I figure out where it happened and why, I will change my views. I mean, if the facts change, I will change.
You had an ideology. You had a belief that that free, competitive, and this is your statement, I do have an ideology. My judgment is that free, competitive markets are by far the unrivaled way to organize economies. We've tried regulation, none meaningfully worked. That was your quote. You had the authority to prevent irresponsible lending practices that led to the subprime mortgage crisis. You were advised to do so by many others, and now our whole economy is paying its price. Do you feel that your ideology pushed you to make decisions that you wish you had not made?
Well, remember that what an ideology is a conceptual framework with the way people deal with reality. Everyone has one. You have to exist, you need an ideology. The question is whether it is accurate or not. And what I'm saying to you is, yes, I found a flaw. I don't know how significant or permanent it is, but I've been very distressed by that fact. But if I may I just finish an answer to the question previously?
You found a flaw in the reality.
Flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
In other words, you found that your view of the world, your ideology was not right. It was not working.
Precisely. No, that's precisely the reason I was shocked, because I've been going for 40 years or more with very considerable evidence that it was working exceptionally well.
Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions.
The President of the United States has already said that the sanctions the U.S. and its European partners have implemented are beyond this. Cutting the Russians off from Western finance generally and going after the oligarchs individually could have a much more significant impact.
China has used the drills in its military playbook to prepare for the invasion of Taiwan.
Are you willing to get involved militarily to defend Taiwan if it comes to that?
Yes.
You are?
That's the commitment we made.